what I want to do today is just kind of share with you some of the things that I look at when I'm considering trading or investing in areas of the market. I always take a top-down approach. So the first thing I want to do is just get a sense of, do I believe the stock market overall is going higher or lower? There's a number of ways certainly to do that, one of which is just simply taking the S&P 500 and looking at it on a weekly chart and seeing if the PPO is positive or negative. Right now it's positive. If you're in a bear market, the S&P 500 weekly PPO is going to be negative. It can't be in a bear market with a positive PPO. Just can't happen. So I think the fact that we've got the S&P positive, we did have that trip in the fourth quarter of last year in the negative territory. We came right back out of it. The last two bear markets, we never went positive on the weekly PPO during the entire bear market. So I think when you can climb back, when you can get enough strength to get that weekly PPO on the S&P into positive territory, that normally is a pretty good sign that you are in a bull market. So I'm starting off with that premise that we are in a bull market. The next thing I want to do is to look to see which areas of the market I want to invest in. Well, I can tell you that with the dollar continuing to remain in an uptrend, and it's been in an uptrend for 8 years, energy and materials, I'm really not going to spend too much time on those areas because they tend to underperform in a rising dollar environment. If the dollar is declining, then both of those groups can be leaders in a bull market. But when you've got a rising dollar, they tend to be laggards, and that's exactly what they've been for the last 8 years. So I don't want to spend a whole lot of time trying to find individual stocks in areas that are showing a history, and for good reason, showing a history that of underperformance. So here's the technology group, the XLK, relative to the S&P 500. So this is not telling us that technology is going higher. This chart down here on the bottom is telling us that. This is just the XLK. So the actual movements in the XLK. Up here, we're seeing relative movements in the XLK. So for instance, one of the problems back in September is you could see technology was moving higher and actually put in a new high at the end of September, but we were actually starting to roll over on a relative basis, which can be a warning sign. Doesn't necessarily have to be, but it can be. And if you notice at the bottom, when the group printed a new low, notice that we actually had a higher relative strength in technology. So in other words, technology was beginning to outperform the S&P 500, even though we were moving lower in the group and in the market overall. So that can be a positive sign. So it's always a good idea to at least take a look at the sector, see what's working and what's not working. Hold on one second. Okay. So when I look at technology, I see a group, and when I look at these relative charts, there's a couple things. On a weekly relative chart, I like to see, my preference is to see price action, relative price action, above the 20-day moving average, above the 50-day moving average, and the relative PPO. Remember, this PPO is tracking the relative price action. So this is a relative PPO. You can have positive momentum in a group, but have negative relative momentum if that group is not going up as fast as the S&P 500. So what this PPO, this relative PPO is telling us is whether or not the group on a relative basis has upward momentum. And so I like to see PPOs above the zero line. So I look at technology and I see a really nice looking formation. Consumer discretionary. I see basically the same thing. I mean, this is a group relative to the S&P 500 that's now been going up for about 19 months, ever since bottoming back in October of 2017. At these recent bottoms in the last 6 to 8 months, notice we've held the 50-day moving average. We bounced right back up. Throughout the entire period, where's that relative PPO been? Above zero. So it's telling you that it has maintained its relative momentum above zero. Now, there were periods when the relative momentum was declining, but you're still above zero. And I think that's really important. When you begin to go into a downtrending period of relative strength or weakness, what we'll normally see is a break below the 50, the 20 will cross below the 50, and you'll see that PPO, the weekly relative PPO, go negative. But when you're above zero, that is going to be an area I'm going to be interested in. So the XLY I think still looks pretty good. XLC, now this is one that I think is just kind of teetering and has been for the last 6 to 8 months. We had a really strong push in the summer of last year, really weak second half of 2018. And then since then, this year especially, just kind of choppy. Communication services really not doing a whole lot in terms of relative performance. A little bit of outperformance, a little bit of underperformance. And you can see the PPO below the center line first 3 months, 4 months of the year. And then we've been above it the last couple, but we're turning lower again. So when I look at this is a group that I'm still okay with, but it's not going to be a group I'm going to focus on because it's not showing me that money is rotating into the group on a consistent basis. And that's what I want to see. And by the way, that's exactly what these relative charts are showing us. The stock market is just a very simple case of demand versus supply. You have a limited number of shares, limited number of companies, limited number of sectors, industry groups, and just depends on how much money's coming in to drive these stocks and areas higher. And when you're seeing these relative charts moving up, it's telling you that more and more money is rotating into that group and less money is rotating into other groups in order to essentially finance this move to the upside. So you want to get into these areas that are showing consistent relative strength, like technology, like consumer discretionary. Industrials, another one that kind of has been on a little bit of a downtrend. In 2019, it looked like we were breaking out, PPO positive. Now we've gone negative. I think this is another group that's, you can pick your spots, but for the most part, it's not really showing us that consistent leadership. Financials, same thing, although I am watching this downtrend. The 20 period is starting to rise and getting closer to that 50. You can see the price action squeezing here. I'd actually like to see a breakout here in the financial group. Now, there are areas in the financials that have been leading for quite a while, even though the overall group has been going down, and we'll talk about that in just a minute. Then we get into healthcare. Healthcare, now this is the exact opposite of what I was looking at with technology and consumer discretionary. You have the relative price below the 20-day, which is below the 50-day, and your relative PPO is below zero. So to me, trying to go into healthcare, you can pick your spots, and there's definitely some leadership emerging. And again, we'll get into the industries and look at that in a bit. But I think you want to be really careful because you have to recognize that overall, since November of last year, this has been a group that's been in relative decline. Consumer staples, another defensive area. It's above the center line. I want you to focus in on something, and I could go back to this prior chart on healthcare as well. The real strength that we see in the defensive groups generally comes when the market is struggling. So the fourth quarter of last year, we saw a huge breakout above prior highs. Healthcare took off on a relative basis. In May, starting in mid-April actually, but through the first half, maybe 2/3 of May, nice relative strength in healthcare during a period when the market was weak. Let me go back the other way. Let's take a look at the XLP, consumer staples. Look at the fourth quarter of last year. Relative strength picks up. April, May, when the market struggled, relative strength picks up. If the stock market goes higher, I believe you'll see these defensive sectors roll back over on a relative basis and move lower. They tend to lead to the upside when the market is weak. When the market is strong, like we saw throughout 2017 and into parts of 2018, you can see that's when consumer staples tended to be much weaker on a relative basis. So yes, I'm still okay with this area, but I do believe if the stock market goes higher, we're going to see what we saw on the rally coming out of December. We're going to see underperformance in this group. And I'm bullish. I think the market goes higher. So this is not a group I'm going to spend a whole lot of time looking at. Real estate, same thing. This, I think, is better than the other defensive groups. I do think that real estate is up for a couple of reasons. Number one, I think when the market gets weak like it did in the fourth quarter, money pours into the group. Same thing April and May. But also interest rates being so low, really helping this group as well. So if all of a sudden the market goes higher with the 10-year treasury yield moving up,
then I think we could probably see a period of relative decline for real estate. So a group that I'm okay with, I'll tell you what, if I was looking for if I was looking to diversify into some areas of safety like real estate, I would only look at the industry groups that are outperforming the S&P 500, and I would concentrate on stocks within those industry groups that are outperforming the S&P 500, all within the real estate space. So that's the way I would diversify if I were to diversify. I'm not a proponent of diversification. I think that, as I wrote in my Chart Watchers newsletter article over the weekend, I think Warren Buffett stated it eloquently. I think that diversification is protection from ignorance. And he didn't mean it in a mean way, and I don't either. It's just that if you're not comfortable, you don't really understand the stock market, it's great to diversify just to be part of the market going higher. But if you follow the market and you're willing to put in a little bit of homework and learn a little bit, I think diversification just kills your portfolio. What is investing in energy and materials done for the last 8 years? Very little. All it's done is really hold your returns back. And the market's been telling us for 8 years not to invest in that area. So again, I think if you pay attention to these relative charts, it can make a big difference in your investing. Utilities, big move up in the fourth quarter, big move up April into May. Again, that's when the market was weak. Of course, you're going to see outperformance there. That's what I would expect. But when the market is strong, it goes the other direction. I would not be a fan of utilities. Energy, here we go. So here's your downtrend. We could pull this. Let's go back. I know it's been 8 years, but we'll go back 10 years. And just look at the relative weakness in energy. If you're in a long-term portfolio and you're quote-unquote diversifying by holding energy stocks, this is killing your portfolio. Has been for 8 years. Same thing goes for materials. This is only the 2-year chart, but you can get the same picture. It's just been a steady relative downtrend until that dollar breaks down, not weakens for a week or 2 weeks or a month, but I mean truly breaks that long-term uptrend line. I would not be looking at energy and materials. All right, that's the sectors. Now I'm going to go through some industry groups. And by the way, I've got 105 industries on this next chart list. And so actually, I think I've got it over here. So I'm not going to have time to go through all of these. I want to point out some of the individual groups, though, that I think look good, maybe a few that don't look so good. If you do have any interest in seeing all of these charts, I actually did a webinar last night at 4:30 with earnings beats. And I will just give you that area. If you go to their website, earningsbeats.com, relative strength webinar, click on it. You can go down here, sign up, and I believe John Hopkins, you can write to John at InvestEd Central, but John will send you a copy of the recording. It was about an hour and 45 minutes. Took quite a while. But anyway, I'm going to start off in this area with the technology stocks or technology industry groups. So this is the way I set up my chart list. So the first 7 charts are 001, just technology, XLK, and then I've just numbered 1 to 7 because there's 7 industry groups. And so I have a chart for each of those. Then I go into XLY, which is 002 for all of these XLY charts, and then I just break them down from 001 to 020. So there are 20 industry groups in that area, and then communication services and so on and so forth. So let's take a look at an industry group. Here is computer services. Computer services, well, I mean, it's looking like it's trying maybe to make a breakout here, but what I see is every time we get a little bit of strength, we just go back down again. So I don't have a whole lot of confidence here. PPO sitting near the center line. I think I'd have to see a more definitive breakout here in this group. So I would personally ignore this. Semiconductors. Now, this one is a tough one. And I say that because if we go back throughout this bull market, this is an area of the market. When it gets going, it can be just unbelievably strong.
So when you look back to, say, 2015, middle part of 2015 until second quarter 2018, look at the relative strength here. So if you owned semiconductor stocks, and also actually it was probably right around here where the PPO goes positive, it stayed that way for 2 years. If you owned semiconductor stocks when they were outperforming the S&P 500, they would have held your portfolio up. They would have single-handedly helped you beat the S&P 500. When I look at it now, I see this recent high, and here's a pullback, which is steeper than these others. But you can see back at the beginning of the year, the group rallied, got back up above the 20-day, went positive, couldn't break out, and now has pulled back. But it also hasn't broken down. So we could have relative strength followed by relative consolidation. I'm not giving up on this group just yet. I would be very concerned, however, if you see this relative movement turn back down and take out the low that we saw at the end of 2018. That would bother me, because then I'm starting to see more of a series of lower lows, lower highs. And when you see that, like here, this is when you want to be out of the semis. So right now, for the most part, I would be out. There are exceptions. I really like AMD. I think Applied Materials, I've been mentioning that one, showing a lot of relative strength. Lattice Semiconductor, LSCC. So there are pockets within the semiconductors that I would still be interested in because we haven't gotten a breakdown. But if we break down, I think those are stocks that you might want to consider exiting. All right, software. This has been an incredible group. And yeah, I know we're having a rough day today. We have rough days from time to time. We have rough weeks from time to time. But if every time we started to see a little bit of a pullback in software, if we decided, hey, it's been too much, we're going to get out, you could see the last 2 or 3 years, that would have been a big, big mistake. Talk about a group completely lifting your portfolio up. It's software. Last 3 or 4 years, this group has been straight up on a relative basis. And until it changes, look at this. We've had really since late 2013, there have only been a couple of brief periods where the PPO has gone negative. This weekly PPO has remained positive now for the last 3 years straight. So that tells me I want to continue to stay in until that strength is there no more. All right. See what else we have in this group. Telecom equipment. Beautiful chart. Just like I showed earlier on that sector chart, I think it was the XLY versus the S&P. Look at that test of the 50-day, test of the PPO center line, turn right back up. So in a group that's been outperforming, seeing it underperform for a period of time, sometimes not a bad thing. You can catch it right before a big move to the upside. But I think telecom equipment remains one of the strongest areas of technology. And look at it trying to break out relative to the S&P 500 again. All right, I'm going to go into consumer discretionary. Let me, restaurants have been very strong. Beautiful move up here in the fourth quarter when the market was weak, but we have exploded here over the past 3 to 4 months on a relative basis and on an absolute basis, setting new highs. So that's why I've had tried to have representation from this area in terms of individual stocks, because I think it's one of the strongest areas in the market. Now, groups to avoid: clothing and accessories. After moving up and being a strong area, look at the PPO. It was above zero for quite a while, but when it went negative here, which would have been back probably about the time it went below the 50-day moving average, from that point forward, this has not been where you've wanted to be. And you can see that PPO staying in negative territory. So I think as long as this downtrend persists, the 20-day stays below the 50, and we're in negative territory, I would avoid the group. Home improvement, mostly just sideways consolidation, not really seeing a whole lot here. Let's see which other ones. Apparel retailers like clothing and accessories, you know, when they're above the 20 and the 20 is above the 50 and we're positive, that's when you want to consider owning stocks in the group. Right now, breaking to a 1-year relative low and in negative territory, very bearish configuration here. I think you're just trying to swim upstream if you jump into apparel retail. Not interested. Let me see. I thought there was one. Oh, footwear. So footwear is kind of an interesting group because I'm not quite sure what to do with this. Remember I said, pointed out that when you get back to the zero line, sometimes that's right before you make a big move to the upside. And here we are, footwear relative to the S&P. Its PPO is sitting right on the zero line. It did go a little bit below the 50-day, came back up, and is almost sitting on the 50-day right now. I'm not sure which way footwear goes here. I'm watching it because if it breaks back up above that 20 and you start to see the PPO turn up, I think that could be a sign that money is rotating back into footwear. All right, auto parts. Look at the relative weakness here. You want any part of that? I don't. That's 18 months of relative underperformance. It's going to be hard to make money in auto part stocks if the group is seeing money rotating away from it like that. All right. Industrials. I'm going to pull up defense because I know defense is having a really tough day today. You can see pulling back. But notice what it did here recently, and this was one of the things that got me interested in defense. Huge run up off of the April low, and you can see the PPO turn positive. Now we're having a rough day, rough week because of yesterday after the open and then today as well. But we're still above the 20 and the 50. I'm going to watch to see if we hold that. But one of the reasons I really like this group is that if we go back 10 years throughout the bull market, look how long this group can show relative strength. And here we are just breaking back in to positive territory. Now, that doesn't mean that it's absolutely going to stick, because I could point you back to 2010. We saw the same thing. Went above the 20 and the 50. The 20 comes up through the 50, and we rolled back over. So if we start to roll over again and we go negative on the PPO, then I would be a little bit more cautious. Railroads, they've struggled a little bit of late. But I think this is an opportunity here. I think railroads have been outperforming for quite some time. PPOs remained positive almost the entire last 3 years. One little blip here where we came right back up. So I think this is an area that continues to outperform the S&P 500 and is definitely a group that I would be looking for. I actually own a railroad, and it's because of the relative strength. All right. How about airlines? Look at the airline group. Just topped 2 years ago, and it's just been the steady move to the downside. Relative PPO below zero almost the entire period. Not looking very good there. And that's with crude oil prices dropping too, by the way. All right, financials. Financials, I showed you they haven't really been that strong, but look at financial administration stocks. They've been awesome versus the S&P 500. And this gets back to my whole relative strength versus diversification article that I wrote in Chart Watchers over the weekend. To me, relative strength is so much more important. Diversification means, okay, I want financial stocks. Let me just go get the XLF. Well, inside the XLF, you've got stocks like this, the financial administration stocks, but also within that group, you've got asset managers. Look at the relative performance of asset managers. So you're taking your relative strength, which is helping your portfolio out immensely, and you're combining it with asset managers, which gave you a sell signal 14 months ago. And yet you're just riding it because you're in the XLF. Great. I'm diversified. And this area of the market is killing my return. So again, I think if you're not willing to spend a lot of time looking at the market, or even a little bit of time, diversification makes sense. I would rather have somebody in the market and diversifying than not in the market at all. But if you're going to pay attention to the market, don't just diversify. I honestly believe that's what Wall Street wants you to do. Because while you're buying these asset manager stocks that are trending lower, guess what their market making units are doing? They're on the other side. They're gladly shorting. So I don't buy into that concept of diversification. I think that all it does is bring you back to mediocrity. All right, so that's pretty much what I wanted to go over. We're going to bring this poll up here in just a minute. We'll get a summary slide and then a poll. Let's see if there's one more chart first. Well, I will bring up in energy because I am a fan of renewable energy. So let's do this as a final chart. Here's renewable energy relative to the S&P 500. And you can see the huge outperformance in 2019. I mean, why wouldn't you want to be part of this? We went positive back in February. And so there's been 4 months of tremendous relative outperformance in this group. When it breaks down, you want to be careful because it can fall apart just as quickly as it rises. But this group's like semiconductors. When it gets moving, it can really lift your portfolio. And right now, renewable energy is very, very strong. All right, let's go ahead and summarize today's relative strength webinar. And essentially what I was showing you, I didn't really get too much into the stocks versus the S&P. I went in the industry versus S&P. But when I look at stocks, these are the three things that I focus on in terms of relative strength. And you see it on my charts here on Market Watchers Live all the time and in my blogs. But I like to see how a stock is performing versus the S&P 500, how it's performing versus its peers, and how its peers, its industry group, is performing versus the S&P 500. Because if we're in a bull market and you're getting the best sectors relative to the S&P 500, and then you're in the best industry groups within those sectors and the best stocks within those industry groups, it's hard not to outperform the S&P 500. So let's go ahead and move on to the poll. I just wanted to see, when we talk about relative strength, I wanted to see how many of you actually look at some of the things that I talked about here and some of the things that I look at. Now, I actually put that first one, the one that's up there at 78%, I put that in there on purpose. And it's not a wrong answer. But I just want to say that relative strength index does not tell you anything about how a security is performing relative to anything else. That relative strength is a little bit of a loose term in terms of relative strength, because all you're doing, it's a momentum oscillator that is telling you whether or not your security has momentum to the upside or downside. It's not telling you anything about how it's performing versus the S&P 500 or versus another stock or versus its peers, whatever. So I just threw that in there to see. I figured that was going to be the number one answer. But I'm actually, Aaron, pretty happy about the high percentages on these other areas. I think it's really important.
Oh, absolutely. And I'm sure, having watched our show regularly, everybody's seen those relative charts. And we did have questions about where to get your relative strength charts, that chart style. And you use it a lot of times in the 10 and 10. So in our live chart list, you can just go to the articles tab and find the Market Watchers Live blog, and then go into the live chart list. And you can find the various charts Tom has annotated, and you almost always include a relative chart in there. And you can just copy the chart style.
Yeah, the other thing,
I'm going to give myself kudos because I did not choose the RSI.
There you go. Yeah, that was just a little bit of a curveball I threw in there. I do want to mention also, under the annotate button, there are a bunch of chart styles for various blog authors and analysts here at Stock Charts. And so Erin has her predefined settings under there. So if you go down to just below the annotation link and it says chart styles, hit that drop down menu and you can go down to my predefined settings and you can pull up any chart using that relative chart list that you saw, or relative chart style that you saw.